Good day, investors. In this video, we will take a closer look at Charter Communications, ticker symbol CHTR. The company just released its earnings for Q1, and the results were somewhat mixed, with some clear weaknesses, and the market reacted quite negatively as investors focused on the continued pressure in the core broadband business and declining earnings. So in this video, we will break down the latest earnings results and fundamentals for the company. Then, we will look at the valuation, and finally, I will give you my personal take on whether Charter Communications is a good investment opportunity right now after the recent pullback. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. So most are probably unfamiliar with Charter, so let's quickly go over what the company does. Charter Communications is a major U.S. telecom and cable company that provides broadband internet, mobile, TV, and business services under the Spectrum brand, serving over 30 million customers across the United States. Now taking a quick look at the company's scale and overall positioning. Charter clearly operates at a very large scale, with tens of millions of customers and a rapidly growing mobile business. The company also has a massive network, covering a large portion of the U.S., supported by extensive infrastructure. On top of that, the company is well positioned in areas like mobile growth, network speeds, and bundled services. Now, if we take a look at the first quarter overview, we can clearly see the main trends. Revenue came in at around $13.6 billion, down about 1% year over year. Adjusted EBITDA was $5.6 billion, also down around 2.2%, and capital expenditures increased significantly to $2.9 billion, up roughly 19%. So overall, this shows a business that is currently facing some pressure with slightly declining revenue and profitability, while at the same time investing heavily into its network. Now moving on to customer trends, which is one of the most important parts of this report. Starting with total customer relationships, we can see that the company continues to lose customers, down about 1.5% year over year, which shows that overall growth is still negative. But the most important piece here is broadband. Charter lost around 120,000 internet customers in Q1, and this trend has been consistent over the past few quarters. Since broadband is the core business, this is definitely a key weakness. Now on the positive side, mobile continues to perform very well. The company added about 368,000 mobile lines in the quarter, bringing the total to 12.1 million lines, which is strong growth of around 17% year over year. And finally, looking at video, the business is still declining, but losses have improved significantly compared to last year, which suggests some stabilization. So when you put this all together, the core broadband business is under pressure. Overall customer growth is negative, but mobile is clearly the main growth driver right now. And that's really the key dynamic we're seeing in Charter's business today. All right, now moving on to revenue, which ties directly into what we just discussed with customer trends. Total revenue came in at around $13.6 billion, down about 1% year over year. So overall, the company is basically flat, but slightly declining. Now looking at residential revenue, which is the largest segment, this declined by about 2.7%, which is a key negative and reflects the pressure we're seeing in broadband and video. On the other hand, commercial revenue was essentially flat, up around 1% year over year, so there's really no meaningful growth in that segment either. And if you adjust for some items like advertising and programming allocations, revenue would have been roughly flat to slightly positive. So overall, revenue is not really growing. The core residential segment is declining, and commercial is only slightly offsetting some of that weakness, which again confirms that the business is currently in a low growth or slightly declining phase. All right, now moving on to expenses and profitability. Total expenses came in at around $8 billion, which is basically flat year over year, so there hasn't been any meaningful cost reduction. Now looking at adjusted EBITDA, this declined to about $5.6 billion, down roughly 2.2% year over year, which shows that profitability is under some pressure. Even when excluding transition-related expenses, EBITDA is still down around 1.8%, so the underlying trend remains slightly negative. And if we zoom out and look at the last 12 months, EBITDA is also down slightly, by about 1.1%, which confirms that this isn't just a one-quarter issue. So overall, costs are not really coming down, profitability is declining, and margins are under pressure, which again highlights the continued weakness we're seeing in the business. All right, now moving on to capital investment and the balance sheet, which helps explain why free cash flow is under pressure right now. Starting with capital expenditures, we can see that CapEx increased to about $2.9 billion in Q1, up significantly from around $2.4 billion last year. This increase is mainly driven by higher spending on network upgrades and expansion, which shows that the company is still heavily investing in its infrastructure. Looking at the last 12 months, total CapEx is now around $12.1 billion, compared to about $10.9 billion previously. So this elevated level of spending is not just a one-quarter event. Now moving over to the balance sheet, total debt stands at roughly $94 billion, which is very high in absolute terms. And net leverage is around 4.2 times EBITDA, or slightly higher on a pro forma basis. The company is clearly in a heavy investment phase with elevated CapEx, debt levels remain high, and leverage is still on the higher side, which means that while there could be long-term benefits from these investments, it also adds risk, especially if the business does not return to growth, which is definitely something to keep an eye on going forward. All right, now moving on to free cash flow and capital returns, which ties directly into everything we just discussed. Free cash flow came in at around $1.37 billion, which is down roughly $190 million year over year. This decline is mainly driven by higher capital expenditures, as well as slightly higher interest costs. At the same time, the company continues to return capital to shareholders. Charter repurchased about $1 billion worth of shares in the quarter, which is quite significant. So, free cash flow is declining in the short term, but the company is still actively repurchasing shares, which raises some concerns about capital allocation, given the pressure on cash flow and already high leverage. Now, after looking at the earnings figures and fundamentals, let's take a look at the valuation and what analysts are expecting going forward. Currently, according to data from Stock Analysis, the stock has a consensus rating of hold, which already tells us that analysts are somewhat cautious here. The average price target is around $298, which implies a fairly significant upside from current levels. However, if we look at the range of estimates, there is quite a bit of uncertainty. The low target is around $185, while the high target goes all the way up to about $510, indicating a potential upside of over 180% at the high end. So you have a very wide spread of expectations, which usually indicates that visibility on the business is not very clear right now. So, there is potential upside based on analyst targets, but the consensus is not strongly bullish, and the wide range of estimates reflects uncertainty around the company's future performance, which fits quite well with what we've seen throughout this report. Now let's take a look at the stock performance so we can get a clearer picture of the current setup. Charter is currently trading at around $180 per share, giving it a market cap of roughly $25 billion. The stock is also trading near its 52-week low, which suggests sentiment remains quite weak. Looking at valuation, the stock has a PE ratio of around 4.8, with a forward PE closer to 4, which is very low compared to the broader market. And if we zoom out, the stock is down over 70% over the past 5 years, which is a massive decline. So, the stock looks cheap on a valuation basis. But that low valuation reflects the challenges and uncertainty we've discussed, which means this really comes down to whether the business can stabilize and return to growth going forward. So when we bring everything together, this was a mixed to slightly weak quarter operationally, with pressure on revenue, EBITDA, and continued broadband customer losses. At the same time, the company still generates strong cash flow, continues to buy back shares, and could see meaningful free cash flow improvement once the heavy CapEx cycle comes down. So the investment case really comes down to one key question. Can Charter stabilize broadband and return to at least modest growth? If yes, the stock could look very cheap based on future free cash flow. But if broadband losses continue, then the low valuation may be justified. That's why Charter today is best viewed as a high free cash flow, high leverage, turnaround style cable stock. The upside comes from lower capex, buybacks, potential synergies, and mobile growth. The risk is that competition continues to pressure broadband growth and overall revenue. So, this is not a clean growth story. It's more of a value and free cash flow recovery story. And at current levels, I would consider this more of a speculative opportunity, where the risk to reward is becoming more attractive after the recent pullback. But execution will be key, and this is definitely not a risk-free investment in my opinion. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.